Welcome back. Is the housing market frozen? We got mortgage expert here, Josh Dobson, to answer that question. Josh, what first off, what does it mean by the housing market is frozen? Everybody's talking about this frozen housing market. Can you kind of take that apart for us?
Yeah, I mean, if you think about it, right, the housing market is like any other market. There's buyers and there's sellers. The biggest issue right now is there's not a lot of sellers and buyers are afraid to buy. So you're not seeing a lot of action going on. There's not properties being listed, there's not being properties sold. So a lot of the transactions are way down to some of the lowest levels we've seen. I mean, if you look at it, mortgage applications are down to the 30-year low. I lost you.
Sorry
Yeah, I
about
can't
that.
hear you anymore.
Can you hear me?
There we go. I can hear you now.
Okay, cool. Make sure we get that straight. Yeah, so yeah, a lot of buyers, a lot of sellers. How much of this is playing into it with the interest rates? I mean, right now, what are we seeing? 30-year rates spike. Let's throw that on. Let's throw that on the. Let's throw that chart on there for the viewers. Okay, we got interest. You got 30-year rates. This is what you guys look at, right, for the mortgage market.
Yep.
All right, we got 30-year rates, pretty much breaking out to what? This is what 11-year high, is it?
Yeah.
Okay, yeah, back 2011. So we haven't seen this level since 2011. And the next question is kind of, before we get to rates, is what's kind of driving this. But before I get there, what is it? So what does this mean for, real estate, for real estate investors? What does that mean for them right now?
So, I mean, what you're seeing is a lot of people looking to kind of sit on the sideline. So, you're going to see a lot of investors who aren't necessarily buying unless they're finding a great deal. And just like I said earlier, you're seeing a lot of homeowners who are second guessing their like entry into the housing market.
Okay, they're second guessing it. And does that give people like real builders more incentive to like build apartments instead of housing, or what are you thinking about that?
Yeah, I mean, you're already starting to see them transition. I think we talked about it recently. Permits are up, but starts are down. Builder confidence has gone way down in just a short amount of time. So a lot of the builders are looking at it from the perspective of, look, are we going to continue to build single family residence, or do we change what we're building to kind of suit what the market is wanting? And the market needs housing, but the mortgage rates and mortgage payments and affordability are affecting people's ability to buy. So the demand's dropping. So you're seeing a lot of the builders look towards maybe building multifamily apartments, things that they can rent out, especially even they're not even really looking at single family homes for build to rent because they're limited on how much rent they can get.
Right, right. That makes a lot of sense. Um, yeah, a lot of it's interesting. I've never seen this before. You're probably used to it. How long? What's your experience, by the way? How long have you seen? Like, when's the last time you seen something like this? Is this new, or are you familiar with this? Is this new to you?
Yeah, this is kind of new. A lot of people like to trek back to 2008. Um, but back in 2008, we had oversupply. We had way more inventory. So it was more of a slowdown in the sense that people couldn't qualify because they either ended up in a short sale, had to let their home go to foreclosure. So you saw demand drop, but supply was still there. And so I think that just kind of eventually kind of got gobbled up as we moved along. So it's a little bit different than that. I've actually never seen this before, simply because affordability like this hasn't really ever been an issue at this level. Because I mean, if you want to go back and look at it, the memes all over the place about boomers and having to pay double digit interest rates and how hard it was for them. Back then, affordability was not where it is right now. It was actually a lot more affordable because of the house price. So we've seen rates climb and housing prices climb to a point where affordability, especially for entry level buyers, has gotten to a point where I would say a large majority of the people who don't own can't afford to buy a house.
Right. Right. Yeah, it's a mess out there. I also wanted to get your thoughts on the whole you've probably seen this, that part of the reason somebody was saying housing is so expensive nowadays versus before, even though rates are not as high, was that the size of the houses keep getting bigger. How much is that? And
It's
this is kind of
huge.
tricky, right? It's like how does
Yeah.
that play into it right there?
So, I mean, that's a big problem that we've had for a long time. So the mini mansions started back in 2006, 2007. If you remember, or if you don't, builders were building bigger homes because people could qualify for it because all you had to do was fog a mirror. So the issue is that they've never gone back to more entry level size homes. So typically in a new construction build, the smallest square footage is like 1,800 square feet. And that used to be a luxury home back when rates were double digits. And I've actually talked to quite a few builders. There's actually a local builder here that I'm pretty good friends with. And his biggest problem here in California is just the cost to get to build, right? So the fees, the permits, everything adds up to the point where it costs them, he said, about $250,000 just to start to build. That doesn't include labor costs, materials. And so the entry level price home and the smaller homes are almost impossible for them to build because they can't build a smaller home and actually have a profit margin.
Wow. Okay. So it comes down to they're incentivized to build bigger, push prices up no matter what. Do you think there's going to be some type of government
Intervention?
intervention? I mean, that's kind of what we're looking at here, right? Q4. Have you seen anybody talk about this other than like Rome? We'll talk about the new startup Rome real quick after that. But do you think there's going to be a government intervention somewhere where they're like, okay, let's incentivize smaller homes. So I don't know how it work. What are your thoughts on that?
Well, the biggest problem is that it's at the local level, right?
Mm-hmm.
So each locality, municipality has their own fees and permits and costs to do construction. It's not a state thing, it's not a national thing. So really, at the end of the day, it either requires the government to cut some of their costs for these builders to actually build, which doesn't incentivize them to build smaller. It just allows them to build more homes and make more of a profit. So it's highly unlikely that that would incentivize them to build smaller homes. So for me, I think the answer comes in the commercial real estate market. This is something that I've seen talked about a little bit, and I wish it was talked about a lot more. But with all the commercial space that we're seeing going and left empty in some of the big metro areas, think about converting that to smaller residential units at a lower price point, giving people access to some sort of ownership and not having the cost. I mean, because again, the building exists. It's just a matter of building the infrastructure and putting in the materials and the labor to convert it to smaller units. I think this is a great way for the government to incentivize builders to repurpose some of these empty commercial buildings that we may never see get filled up again.
Okay. Yep. Yep. So it sounds like even going forward, there's too many big commercial. There's a lot of space, and that space needs to be converted into something that makes more sense, more productive, and for people to actually move in smaller spaces, smaller prices. And I've thought about that for a while, which is maybe there's going to be a secular move towards smaller houses. I mean, we have I mean, if you compare us to the world, we're like what, 10, 20x bigger spaces than India. You go look over there, they have a lot smaller spaces and they're doing a lot better as far as paying off their debts. And I guess the incentives are just not good right now. Hopefully that improves. So what would you say to the first time home buyer right now? I wanted to get this question off. There's a lot of people, okay, they're looking to be a first time home buyer, but they're not sure from your point of view, they're not sure what they should do. And I know everybody has a special situation, but just I guess in general, do they go chase? Because I think the two scenarios are, Okay, buy a house, go get a house right now, right? Pretty good price, something you can afford, and wait to refi, or stick into an apartment and wait for the housing market to crash a little more. What are your thoughts on that? On those two ideas
So
right there?
I'm kind of different in this respect. I hated the marry the house, date the rate, right? That's the buy something now and refinance later, because at the end of the day, you're not guaranteed to be able to refinance later. There's nothing guaranteeing that we're going to see interest rates go down anytime soon. And so if you're buying a house with the sole purpose of refinancing it later, you're putting yourself in some unrealistic expectations. So for me, I think it comes down to adjusting your expectations, figuring out what you do qualify for, what you can do to put yourself in a better position to be able to buy something. But waiting for housing prices or interest rates to come down, you may be waiting a long time. And I don't think we're going to see a crash like we saw in 2008, where we see prices drop 30 to 40%, which would help affordability a little bit. But at the end of the day, and I think this is where people kind of mix it in with auto loans, uh, the lower the price or the larger the down payment has less of an impact on your monthly mortgage payment than what the interest rate does. So there are a lot of things that you can do as a potential home buyer to lower that cost, that interest rate, especially as we're starting to see the market slow, right? So if sellers aren't selling their house quickly and they're looking to move their home, they're going to be incentivized to offer concessions. And those concessions can be used to buy down your interest rate, whether it's a temporary or permanent, which is a great opportunity. Now, getting pre approved and going and looking at houses, you really have to be patient. You can't just pick the first home that comes on the market and accept whatever you get. So I think for first time homebuyers who would like to become homeowners, I think you start the process now. You find out what you qualify for, how much you can afford, and set a budget, right? Plan for it. And with your goals and your budget, you really focus on being patient, getting into the market, shopping, but not just accepting whatever you get accepted. Like, you're going to have to learn how to maybe write offers that aren't great, I mean, lower price, large concessions, getting turned down, but staying patient, because if you're able to stay patient, you're able to get the concessions, even the price reductions, you're going to put yourself in a better position. I think right now, a lot of people are just so eager to become a homeowner, and they're so used to the previous market, which was you had to write $150,000 over the sales price and just be fortunate to get your offer accepted. That's not what's happening right now. You've got a little bit more leverage as a home buyer, and you really have to really apply that leverage and be patient.
Okay. And hey, those are good little tactics if you're first time or you're looking out there. Would you what about Rome? What about the startup Rome? Tell us a little bit about what they're trying to do, the startup Rome, and if it kind of makes sense, where are the loopholes in that?
Yeah. So Rome is a third party service. They're going to bring people with assumable mortgages to the market. That's the plan. I I don't know how successful they're going to be. I mean, are they going to market people who have FHA, VA, and USDA loans and offer to help them sell their homes? Or is the potential home seller going to have to find them? That's kind of the disconnect that I see right now. Because at the end of the day, Rome is just an intermediary. They're going to take those people with assumable mortgages and negotiate or help potential buyers move in to assume those mortgages. And again, these are just FHA, VA, and USDA. So Where do they bring them to the market, or are they waiting for people to bring them the market? That's kind of a disconnect, because you don't hire them to negotiate the assumption for you, because at the end of the day, that's like using a realtor, because a realtor could do that. So I think it's a great concept, not for the cost. I mean, 1% to have them maybe bring you the seller or negotiate that for you. Again, that's just kind of an area that they really haven't, since they're so new, really expressed what they're going to do. So it's a great concept, little expensive, but I don't think there's a market for them, and I don't know if they're going to be able to bring enough to market to make it impactful. But the next problem with it is, and this is something that not a lot of people talk about, when you're assuming somebody's mortgage, you're assuming the mortgage that they currently have. So hypothetical situation, the house the seller is trying to sell is for $350,000. They owe $250,000 on the house. You as the buyer either have to bring in the $100,000 difference, the seller has to finance the $100,000 difference, or you have to find an institutional lender who will lend you the difference. The problem is institutional lenders will not lend you 100% of the difference in a second position lien. So typically it's a second mortgage. You're going to have to find a lender who will lend up to, and the highest CLTV or combined loan to value that I've seen for seconds is around 95%. So you'd still have to come in with 5% down to assume that first mortgage and have a second lien to purchase the property. Most sellers aren't going to finance the difference because most sellers need that money. They're going to they want to take that money and they want to reinvest it in real estate, or they need that cash. So you miss out on two of those there. And then most buyers don't have $100,000 for a down payment. Not in this market, especially first-time home buyers. Now, there are some people who will be selling their houses and they can use those funds to pay the difference, assume that mortgage. I think that's where that intermediary, that niche actually works. So you could see a lot of people who currently own, sell their house, pay the difference, and assume somebody else's really inexpensive mortgage. The assumption process isn't just as easy as saying, hey, I'm assuming this, sign some paperwork. The servicer of that loan is going to have to approve you for that loan. So you're either going to have to show the funds. The second, it's just like going through the whole home buying process, getting a mortgage. So it's great in theory. I mean, we've had assumptions forever. And a lot of realtors will list these properties and say, hey, we have an assumable mortgage. Again, the issue is financing the difference or paying the difference.
Right. So it sounds like it just might not scale. It's probably not going to scale, which brings you to the next question is, okay, well, what the hell is going to get these prices lower, right? We have a question in the chat really quick, Chavez. What about fractional home buying? Not a very, I don't know exactly what you mean by that. What would you say? What is fractional home buying? Is that something in your niche as a mortgage expert?
So I'm assuming talking kind of like a co-op, being able to purchase a percentage of a home, or multiple borrowers buying and separating the cost to own the home. That's a possibility, right? Because you can have up to 5 people sign on a mortgage to buy a house. So if you want to pool together your friends and your buddies and you want to buy a house together, you could do that. There's not a lot of fractional ownership as far as a market, because a lot of sellers aren't going to sell a fraction of the ownership in their home. So it really depends on what you mean by fractional. But there are options. There are things that you can do to become a homeowner as a fractional owner. It's just a very small niche.
Thanks. Hey, real quick, we're still getting this together. How's my mic now? You guys that are in there, appreciate you guys letting me know. Want to make sure the mic is straight so that you guys can hear me. I turned it up a little bit. Isaiah, let me know how the mic is. All right, we got another question here for you. I wonder, or another comment. I wonder if a 40-year mortgage, 40-year mortgages are coming. It's difficult for buyers. What are your thoughts on that?
It's going to be really hard to kind of bring a 40-year mortgage to market. That's the biggest hurdle that I think lenders are experiencing right now is that there has to be a secondary market for it. Most banks don't hold on to your mortgage. They're going to bundle it and sell it. So the reason why 30-year fixed mortgages are so popular and they're so readily available in the United States is because we have a great secondary market for those mortgages. And so unfortunately, it's like a 15-year, right? So the 15-year bond market is better, right? It's lower rates because it's a shorter term, but there's not as much fluidity in that market. And so you don't see the rates really be that much of an improvement over a 30-year fix. So you throw in a 40-year, you're going to ask institutional investors to take that risk on for 40 years. So you're not going to probably see that happen. And the biggest issue really that most people don't talk about is Dodd-Frank. So there's legislation that does not want to see 40-year fixed, interest only, neg am. So a lot of those products that were used in the past for affordability are difficult to come to market because of Dodd-Frank and because of the secondary market. There are 40-year mortgage options, and it's hit or miss, right? Because it's specific investors who are willing to portfolio those loans and hold on to them. 10 years to the loan doesn't save you that much. It doesn't really create that affordability that we really need because of the rate, right? Because the rate's going to be so much higher than the 30-year fixed mortgage because there's not a secondary market for it. But also another issue with it is, again, where do we find the affordability? And it's not really creating exotic products or extending out the term of the loan, neg am or interest only. It's going to be the interest rates themselves. And I think what's going to have to happen, and I think you and I have talked about this a little bit, the Fed's going to have to do something. There's got to be some sort of quantitative easing to kind of stimulate the economy, get people moving towards buying homes again. And that's on the horizon. It's just not right now because they've got to get inflation under control.
Right. So, that is the big question here. We got rates, rates are surging. And that's the next question. Why are rates surging? Because everybody at the end of the day wants to know how do we get prices lower, right? How do we get lower housing prices? If you own a home, people are a little upset. Hey, you tell me really quick, because you're already in this market. Are people, because everybody wants the lower prices, but what about the people that already own a home? Aren't they upset that prices will come down? You know what I'm saying? Isn't there a kind of a contradictory outlook there? Some people want to maintain because their homes went up in value a lot. Others are upset because they're too high. You being a mortgage expert, how many people actually don't care? They really don't want that to change. Do you run into that?
I think everybody wants it to change. You got to remember, your home price is just what somebody tells you it is. It's a just number, right? Because you can't actually access that money. So yeah, it increases your net worth, but that's not money that you have in the bank because you can't access it unless you can pull the equity out, sell your house, refinance, pull out a bigger mortgage. Nobody's going to pull out a bigger mortgage because interest rates are double, almost triple what they probably have. And if they sell, they realize I'm going to have to buy another house. If I buy another house, double, triple interest rate, it's not a good move. So I really think current homeowners are the golden handcuffs, right? Most of them, hey, I'm buying this as a starter home. I was planning on selling it and buying another home 5, 7 years later, but now I can't because I can't afford the new mortgage, even if I put all of the equity from the sale of my house down on the next house. So I think people are looking, and I would say most people are looking for home prices to pull back a little bit, especially those who own their houses free and clear. 40% of U.S. Homeowners have no mortgage, but they're still paying property taxes, and those prices are driving up those property taxes, which could drive them out of their homes. So I think a lot of homeowners are heavily invested in seeing the housing market cool off, maybe pull back a little bit, and the Fed do something to kind of bring affordability back to the market.
Okay, because they are also, even if their housing, even if their prices are up, they're still trapped. It's not like they can
Yep.
do anything. They're pretty much trapped too. So, okay, that makes sense. We have another comment here. And if you guys have questions, this is the guy to ask about the housing market here, right? We have, if you're self employed, are there banks that offer homeowner mortgages mixed with a business loan to account for the business expenses, size of the cost of the mortgage? Make sure you guys' questions are pretty clear too, also. I'm going to just read them straight out. Josh, what do you think?
So, as a business owner, right, some of the biggest hurdles for people to become homeowners as business owners is qualifying for the mortgage. So, when you file your tax returns, you're hiring good CPAs, bookkeepers to drive down and keep your taxes at a minimum, which affects your ability to qualify for a mortgage to buy a house. So, there's not a lot of programs that will let you finance it as a business. But the great part about this is working with a mortgage professional who understands tax returns, especially if you're doing it right. And I think a lot of people don't realize this. If you're paying your credit expenses through your business, those expenses are not hit against you in your qualification for a mortgage. So if we can document that you're not paying your car loans, your credit cards, or anything through your personal account and through a business account, those can be excluded from your debt to income ratio, which will increase the amount that you can qualify for. Again, going to be looking at those tax returns. Those tax returns is the net plus depreciation plus mileage. That's about what your qualifying is going to be based off of. There are some additional programs that are specific to certain investors who don't require tax returns for self-employed borrowers to buy a house. These are bank statement loans. And there are some products that allow you to qualify based on the rents being received if you're going to own or occupy. There are some that don't have income verification. It's called a community loan. The rates are a lot higher, but it does allow you, as somebody who doesn't report a lot of income on your tax returns, to be able to buy a house, but typically 10, 20, 30% down is required for those programs. So for those of you who are business owners who want to become a homeowner, my suggestion was talk to a mortgage professional, get your tax returns looked at, have a number in mind, figure out what you like how much money you make according to a lender, and then develop a plan so that you can actually qualify for a mortgage, getting a full doc, 30-year fixed mortgage to buy a house with minimum down, or unless you have a large down payment. Get the best possible terms, but creating some sort of plan as a business owner. I mean, you plan all the time about your expenses and the income that you're receiving. If you really want to become a homeowner, you should really plan for it as well.
Thanks again, Josh. Hey guys, make sure hopefully that answered your question, Doifer. Make sure your guys' questions are clear and succinct, okay? So that it makes sense. That everybody can look. Oh, my bad, messed up the display there. Chavez, he says, what's the biggest mistake that you've made in real estate?
Good question. Biggest mistake I've ever made was buying into the frenzy. So prior to 2008, I bought my first house in 2004, straight out of college. And this was when the market was going pretty hot and heavy. I definitely got into the frenzy. I had a neg am loan. I bought a couple properties. And I think I bought into kind of, hey, everybody's buying, you might as well buy. Prices are going to continue to go up. And that was a learning curve for me. Like I learned that it's just like any other market. They have cycles. And I mean, fortunately for me, being in the business and having some accountability to myself, I didn't short sell properties. I didn't let homes go to foreclosure. I figured out how to manage them, get them to hold them long enough so that way when the market rebounded 10 years later, 15 years later, I was able to refinance them into a 30-year fixed mortgage, and I still own all the properties that I bought prior to the 2008. But I think the biggest thing I learned was something that I've heard multiple times. When everybody's buying, it's a good time to sell. When everybody's selling, it's a good time to buy. So don't buy into the frenzy because it's what's important to you, and your timing is your timing.
Yeah, I agree. Hey, I messed up again. So going back to, investing in general, right? Sorry, my mouse when I was pissing me off. Um, I'm like, bro, come on. I got this technology. It goes out on me.
I hate technology sometimes.
Yeah, me too. My brother's a tech guy, so he always helps me out with it. So, hey,
It's
it
good
comes
to
back to
have.
the same concept. Like, I don't agree with Warren Buffett right now, his picks, but his concepts are gonna last forever, right? Which
Yeah.
is sell fear. I'm sorry, buy fear, but
Mhm.
not like right away, right? Let the fear
No.
sink in. Let the
Yep.
fear really sink in. Where, but it's like, okay, financial crisis, stocks, whatever it is, and then sell the greed, right? Not little greed, but right. Would you agree? You want to let the greed set in a little longer,
Oh
and
yeah.
then boom, that's when you start to sell. So same concept, guys. Same exact concept. We got that through. Again, send your questions in pretty clear. What do you think about the rise of short-term rentals like Airbnb?
Yeah. Um, eh, it's funny, right? Because we're all on social media and we see a lot of these influencers who like to post about things, and a lot of it seems like fear mongering, clickbait. Um, Airbnb is a great concept. It works well. Obviously, a lot of people bought into it who probably did not do their research and aren't putting themselves in a position so that when the cycle ends and you see that market start to soften, especially as people stop traveling and spending less money, that they're going to be able to afford those mortgages that they got to buy those homes without that short-term rental. Now, fortunately, they can fall back on the housing shortage and turn those into long-term rentals. So I don't think the whole hype on the Airbnb market is going to cause a housing crash. It's a huge bubble. I actually did a video on this. I think there's a little under a million Airbnb listings in the US. Only about 75% of those are non owner occupied. So 25% of that million, 250,000, are owner occupied homes. People actually live in them, they pay their own mortgage, they just rent out ADUs, other rooms in the house, whatever it is that they do. So let's just say all 750,000 of those Airbnbs that are non owner occupied hit the market, which is really unlikely, right? That's 750,000 homes on top of what we have now, which is about a million. So that's 1.75 million. Now contrast that to 2007, 2006. 4 million active listings when that market crashed. So we're not anywhere near that level with those numbers. I think Airbnb, you're going to see some inventory come, which is going to help with the softening of the home prices. We're going to see prices pull back a little bit, the market cool off because of some additional inventory because of the Airbnbs. But I really don't see that crashing the market. My biggest fear and what I am looking towards is unemployment and the job loss. Because when we see that start to climb and we don't see a healthy economy because people aren't hiring, those people are going to have to find a way to afford their mortgage because they may have one, right? And typically people who lose their jobs first don't necessarily own, they're probably already renters, but those renters are paying somebody else's mortgage. So if that landlord can't pay their mortgage, they're going to have to sell their property. That's where I think the real issue and the problem could be in the housing market going forward.
Okay, yeah, that makes sense. Unemployment. So we're gonna geek out on a little bit of the macro too here. We're at 3.938. We're at 3.8 right
38.
now. Um, how much higher do you think we go? I mean, I'm thinking it's tricky because we're like headed into this, like we're like kind of recovering in some areas and then we're like dumping in other areas, right? So where do you think we peak out in, I guess, in the next, I would say the next 3 months, because things can drastically change from what we're seeing here. We can see like it could go to 4.3, it could stay at 3.5, come right back down. Where do you think in the next 3 months going into year end, I would say for Q4, where do you think unemployment goes?
You and I talked about this at great length, right? We kind of geeked out on it, the gig economy. I don't think the true unemployment number, the one that they like to give us, is going to rise over 4% before the end of the year because I don't think the data is as accurate as it should be.
Right. I don't think so either. Do you think the data is, well, I mean, we did talk about this, right? They had to remove all the jobs, all the revise them down. I think it was like 300,000 jobs got revised down
Yep.
for the year. So, and that's the year's not even over. So that's like came out to like 30K a month, 30,000 jobs a month. So unemployment's
Yep.
probably higher. We're using these old legacy systems. It's probably a lot higher. But then you also get the tricky part where, okay, it's higher, but then a lot of people aren't reporting their income also. So they keep spending anyways because they can. And so it's kind of tricky. We're kind of stuck in that area. Before we jump into that question from Doifer, any book recommendations about mortgages and homeowner microeconomics? Good question.
That's a good question. Off the top of my head, I don't have anything. But yeah, I don't.
It's like all in the head. If it was in a book, I mean, if it like literally markets are funny because if everything that made sense was in a book, nobody would fail, right? Everybody would be rich. Everybody
There's a
would do
book
their,
on every concept, every nook and cranny. There's some that are good that to some people, they're better for others. They're not good for this person. I think it's just about any book is great because you can get somebody else's perspective, their learned experiences. Because I mean, that at the end of the day is understanding as much as you can about the housing market is crucial to making good decisions. But there's not like one book out there that's going to make you an aficionado when it comes to being a homeowner or investing in real estate.
yo, Doifer, I would say this. Look, in the show notes, we're gonna have Josh's social media. I would literally just go look at his Instagram. He has a lot of good content and just go crazy on his content. I mean, a lot of people don't like to read nowadays. Videos are easy, but take notes. When you watch this video, don't just watch the video and be like, "Oh, that was a nice video." Okay, it makes it. Take notes. I have so many friends who will watch videos, but they can't retain the knowledge because they're not putting it back down on paper. So, throw his stuff down, archive it, and we'll have that at the. It's not in there right now. We'll add it in there at the end of the video. So check that out. You got to go after specific people who've been in the industry and then kind of see what they've learned, see if it matches what you've learned. So same thing here with the stock market. There's no books, there's no college, there's no education. Like it's not that people lie, it's that everybody's situation is so different and the
Time in the
market
market.
changes so quick. It changes so quick. And there's these core fundamental rules that you want to know, but they don't tell you what to do. They just kind of tell you what is, and it's a bloodbath out there, right? You have to fight to have the edge. Most of the time, the guys who have the edge are the ones that are doing the opposite of what people think. That's typically, in the right timing, not just because, but with the right timing. So it's a performance sport. I like to say it's a mental performance sport. Investing, it's not easy. Nobody hands it to you. So yeah, go check out his content there. Another question: do you think housing is the first thing to roll over during a recession?
No. I think because of Dodd Frank, because of the housing shortage. I think housing is going to be one of the last things that really comes down. I think everything else is what's going to pull it down, which is a lot different than 2008. 2008, the housing market is what led to all of the economic problems. So if you're looking at it from a micro level, residential housing or real estate is going to be one of the last things that really comes down. A good leading indicator might be commercial real estate. They're hurting right now. And that could be the pointer as to what kind of starts the slide down in prices for just about everything.
Hey, real quick, what is Dodd-Frank? I know a lot of people don't even know what that is. They're probably
Yeah.
just saying.
So that was legislation passed after 2008. I want to say it passed about 2010. So because of 2008, the federal government decided they needed to put in as much legislation as possible to protect the consumer from what happened prior to 2008, right? The predatory lending, the adjustable rate mortgages, the subprime mortgages, the negams, the 40-year products. I think we had a 50-year product at one point back before 2008. So it's legislation that was passed to help kind of keep the markets from experiencing that same thing. So they've kind of banned certain things as far as products. They now have what's called the qualified mortgage, which is you've got to qualify for the mortgage. It has to meet certain criteria for it to kind of be omitted from what would be considered a non-qualified mortgage, which if you were to ever default on your mortgage and you were a non-qualified mortgage, you could sue the bank and the federal government would have your back on it because they didn't follow the rules set forth in Dodd-Frank. So the legislation is huge. There's a ton of stuff in there, but specifically it was meant to prevent certain types of products, certain types of lending, to protect the consumer, and really force the lenders to not go back to the stated income or the no income type mortgages. So it's why lenders now require pay stubs, W-2s, tax returns, bank statements. We've got to be able to prove that the person getting the loan has the ability to repay the mortgage. It's called an ATR.
So basically, the government has your back if you're uneducated and make a stupid decision. For you Americans out there, they got your back, which is part of the problem too, because it's kind of like a security blanket. Not to say that people don't, get preyed on, but the more systemic issue I think we would agree is education,
Yep,
the
financial
part
literacy.
financial literacy. Yes, not in school. They don't really
No.
teach it in school. I was a teacher for 5 years, and they didn't teach anything about that. That's why I'm here. And it does rip people off long term. But then they, okay, Dodd Frank protects them, which is good for some people. But the systemic issue is, you need to get out there and learn. Stop watching TV. Stop watching TikToks and Instagram shorts. Go out there and educate yourself. Weaponize yourself. Equip yourself with information, knowledge. Execute. You're gonna make mistakes. Don't be afraid to do it. Ask questions. That's why we have these podcasts, right? So again, we were talking about recession, right? Going into recession. What do you think is so how do you classify recession anyway? Because I hear it all the time, right? Recession. We're going into recession, and we'll get to what gets housing prices down too, but it's usually recession. I argue, hey, we're in this rolling recession. We're not like in a deep recession. But there's a couple things. There's employment, there's GDP, there's economic activity that goes negative and starts to contract. There's a couple things. What do you think? How would you bundle up what a real recession is? Not this half-hearted thing, but a real recession. How would you bundle that up from your experience?
Yeah, you and I talked about it, right? The primary definition of a recession is 2 negative quarters of GDP. I think that used to be a good indicator as to a recession, but because of consumer spending, access to credit, I don't think we're really seeing those numbers provide a real clear, yeah, we're in a recession. personally, and this is, I guess, for me, my definition of recession is when things become tough for me, being able to afford to buy my groceries, pay my mortgage, do the things that I was doing previously. So I really feel like you hit the nail on the head. This is more like a rolling recession. But I still think it's kind of compounding. It's getting harder and harder each and every month the longer this goes on. And I think that's where we could see the recession really hit us hard later on if there's not some sort of pivot from the Fed.
Right. No, I agree. Some sort of pivot too, and everybody argues about that too. Everything is context. Everything is predicting, looking forward. There's no absolute signal, guys, that tells you you're in a recession or that we're going into a recession or we're not or we're going to recover. There's no absolute signal. It's kind of like dating a female or a female dating a guy. You got to pick up on the signals, okay?
Yeah,
And you
the
got to make a
nuances.
choice. Yeah, the nuances, right? Nobody's gonna tell you exactly how it works, or else we wouldn't be having these issues. That's not how it works. So this was the negative GDP we got January 2022, and these are in two. GDP is always lagging. It's backwards looking, guys. So like the way I look at it is when you do have GDP. And you see the court, which we're getting this week. So we have six Fed speakers, by the way, because we're going to get into this economic activity today through Wednesday. Thursday, we got GDP quarter over quarter. We got Powell speaking. Friday, we got PCE, which is the Fed's preferred inflation gauge, and we get the consumer report. Now, what I wanted to get to is we do have that GDP number coming out. Back when we had negative GDP, right? This is backwards looking. So it's really and you tell me how you thought about this, Josh. I'm like, well, it was negative, but it's always versus the prior year,
Yeah.
right? So it's kind of like we had this gigantic boom to the upside. And when you cool off, it's so big that it's going to look like a recession GDP wise, but it's not really that deep. And nobody's really feeling it because, like you said, you have all this economic activity still going on. So it was a technical recession. And then so
Yeah.
you hear politics kind of use it to their advantage. You know, if they hate whoever's in house, oh, it's a recession, he sucks. And then if you're for, well, it's not really, unemployment's still up,
Yep.
which are both right. And so now we bounced, and this is basically what we're looking at here. We're still floating in positive. And I would say, yes, unemployment never. So during this time we were negative, unemployment never went up. And maybe the answer was just that, hey, growth was so strong, it didn't matter that it decelerated into negative because it needed to decelerate to some degree, but you still have a lot of money in the system. You had the services economy still hot. And then we'll look at the service economy. Manufacturing went negative and services stayed up. So you had a rolling recession. You don't really get that full rollover. And I think the next question here is, where's the recession? So that's what we'll get to. Where is the recession? How do you think we get into recession? Or you did say the Fed. What gets housing? Let's go to housing prices first. What gets housing prices not to disinflate? Because we already had we already have kind of disinflation a little bit. Shelter inflation is rolling over. But what gets us into deflation from your view? I'll give you my view afterwards. Tell me what gets us into deflation where housing, I know what moves stocks lower. Like I could tell you that, but housing, I'm not, too privy to that. What gets us to housing prices lower?
A spike in unemployment, my friend.
Spike in unemployment. Simple as that. Spike in unemployment gets housing prices lower because what? People can't
afford their
service
mortgages.
their debts. They can't afford the mortgages. They start defaulting. So how does that process look? Do people literally default? I'm still, I'm a lot younger than you, so I never really experienced the financial crisis. I think I was 18 years old, 2009.
Okay.
I was going into college. I didn't even know there was a financial crisis. I had no clue what was going on. I went into college where they're still going to give you debt. So I was like, hey,
Yeah.
what crisis, right? So what is sort of that process? People walk us through the process of, we're not saying there's going to be a collapse, but walk us through the process of how that transitions into lower prices. Do people just sign, they default, they say, I can't pay it. Do they move out of that house? Do they stay in the house and get some government program? Do they go rent? How does that kind of flood through?
So, I mean, it's always a little bit different. It just depends on what's going on. So in this respect, with where interest rates are, it's going to be a lot harder for those homeowners who owned 3 years ago and further back to really feel the pinch of not being able to afford their mortgage, simply because their mortgage payment is so low. But typically, what you're going to see is uh, homeowner X loses their job, no longer receiving any income, and they're starting to receive unemployment. The difference this time is homeowner X may start gig work. They're doing DoorDash, they're doing Uber, Lyft. So they're able to kind of hold on to that mortgage. But what you will probably see is credit card debt credit default start to tick up, car loan default start to tick up, and the last thing to tick up is going to be mortgage default. So you can actually get the data on mortgage delinquencies and mortgage defaults. So the process is you start to fall behind on your mortgage. They're trying to recover that payment. So what's really cool about it now is that a lot of the banks have arms within the bank to help homeowners who are struggling with their mortgage figure out ways to mitigate it and keep them in the home, which was completely different in 2007, 2006, 2008. Banks didn't have arms to deal with problems with mortgage payments, which is why you had people short selling and foreclosures taking forever to come to the market. Most banks have a lot of people working in these sections of the bank that if you contact them, like you can't afford your mortgage, if you contact them directly, they will work with you. They'll do things like push payments to the end of the loan. So they'll extend the loan out. They'll modify the loan. And if you're working with them, they'll work with you until it comes to a point where it doesn't make sense for them to continue to work for you. And you will then need to either sell the home or let it go to foreclosure. That's, I think, where, as a homeowner, right, if you own a house and you have a mortgage and you start to fall behind, the sooner you get out from that house and you sell it, because you're going to have a lot of equity, right? Hundreds of thousands of dollars in equity for just about everybody that owns a house right now. So if you do start to fall behind on your mortgage, the trick is to get it listed, get it sold, and move into something else. If you hold on to it for too long and everybody else is listing their home and selling it, we're seeing inventory rise, starting prices to start to fall, and eventually prices fall enough that you no longer have that equity, and then you're going to see short sales. And if short sales don't work, you're going to see foreclosures. So the average homeowner hopefully will, if they start to fall behind, sell the house, move into a rental, use the money to pay off their debt and put themselves back in a better position. Those that wait too long or get to the tail end of this are going to either have to short sell their home and move into another home. And eventually they're going to have to, they'll end up letting it go to foreclosure, because a bank loses more money foreclosing on a property and selling it as real estate than they do if they help you negotiate a short sale or sell the house. So they're going to work with you.
Okay. So
But that's one of my biggest fears, right? The whole own nothing and be happy. What if that whole movement moves into the banking industry and you see private equity firms come in and buy up these properties to turn them into rentals and never re-hit the market? So we don't see an influx of inventory.
hey, we just got to look to Elon Musk, man. He's gonna build the next, small ownership digital housing market. I don't know. I guess this is kind of where you're at the end of the road, and some technology needs to come in
Yeah.
and change things up a little bit. So, I mean, hey, who knows? I really don't know. I'm just tracking it on a monthly basis, but those are some good details. I don't, really good insight here. Make sure you guys take some notes here. So I think really it comes down to the Fed, right? It comes down to the
Yeah.
Fed. What are they going to do? are they working together with the with the Treasury? Are they working with, so you have Janet Yellen, right, US Treasury, you have the Fed, Jerome Powell, and then you have his whole, his whole caucus, you could call it whatever, and you have Joe Biden. But let's keep it real, he's not really there. It's just kind of, the administration. So are they working together? I kind of think they do. There's all these theories, right? I kind of think they are working together here, which is hold rates higher because we need to flush out all these prices and make sure people know that we're really not going to capitulate here, but at the same time still inject liquidity through
Right.
fiscal policy, and really keep injecting liquidity through fiscal. And then we see the RP. I haven't even looked at it, the reverse repo facility. Let's take a look at that. Let's see if this thing is still pumping. It's funny you said this caught your interest on one of my videos over here, looking at Ethereum, of course.
It's the Fed's tool belt, man. You don't know what they're doing. They're doing something all the time.
Here it is. No, here's the RRP. So what's the RRP doing? So the reverse repo facility. Oh, look, it's starting to lift again.
Yep.
So here we go. And I have it inverted because it makes more sense. It just kind of looks like the market here.
Yeah.
So it's inverted. And I also saw earlier that Treasury issuance was slowing on the long end. So I'm kind of surprised that this is 10 years. So 10 year, I guess, is considered still a bill. And then after that, it's a bond, whatever, who cares? 30 years still going higher. But you have this facility still moving up, which is why, when it comes to stocks, I'm still a little more bullish. But for the most part, the Fed is still injecting liquidity here. The Fed, are they do it? Like, how do they do it? It's sneaky, right? You do all kind. There's 10 ways to cook a hamburger, to
Yep.
make eggs, right? So they're still injecting liquidity. And then again, that fourth quarter stimulus from the White House, I guess you could call it, because kind of what they're doing right now. And then, let me know how you think about this, is they're issuing all these treasuries, which is pushing up rates. Do you think it's the treasury issuance that's pushing up rates, or do you think it's bond vigilantes, like I like to call them, where they're just selling, they're shorting bonds, or they're selling the bonds, or they're shorting bonds, or is it too much issuance, too much supply? What do you think about that?
I don't think it's too much supply. I think you're spot on with the vigilantes. You're seeing people who are tired, and the way they're getting hurt by purchasing the treasuries and our rates being so high. I think a lot of the countries are realizing that, hey, we can't continue to fund that big machine and kill our economy. So I think you're seeing kind of just a slowdown in the demand and some people betting against it because of that. And we can't continue to not just keep issuing new debt. We keep racking up more debt. So we've got to borrow it.
And here you go. Here's one of those guys, Bill Ackman. Here's Bill Ackman shorting the 30. Here, this dude is destroying your mortgage rates. Here's the guy, right? And he's going to cause a ruckus. Now, this was back in early August, but now they're doubling down. It seems like they're doubling down, tripling down. For me, I'm like, damn, slow down. You guys chill out. But I think this is the game plan, is they're coming out and saying it to get people to keep shorting the bond market. Also, China was the biggest buyer of China. Japan, I looked at
Japan's number two.
Japan's number two. And I looked at Japan. They're not really dumping treasuries the way China is. China is dumping insanely, right? The Fed is dumping treasuries, but not really, because the reverse repo is coming in, sucking up the short term, whatever. So I think this is it right here. These guys are, the Fed is trying to get them to capitulate, in my view. I think what the Fed's trying to do is say, okay, you guys want to keep shorting the market, go for it. What we're going to say is we're higher for longer, which actually makes you double think, how long can we keep this short? Because if something does break, you guys are going to have to capitulate. But the Fed, it's not working right now. Their language is not getting them to capitulate. And it's really backwards looking, because some people say, well, the higher the Fed is, the more that you should short bonds. Well, but actually you're getting closer to a hiccup. And that hiccup, some dude tried to argue with me the other day and say, if something breaks, it doesn't matter. That's actually going to make rates go higher. I'm like, hey, bro, what do you think this was right here when the 30-year just dropped like a rock? I mean, what was this? This is a big move. You got the 30-year coming down 21%. That was SVB. That was a collapse. Oh, what do you get? You get the reverse repo facility. I guess it drained
a ton of liquidity.
Yeah, more liquidity. So again, I think that's what it comes down to is I mean, what do you think? Do you think the Fed's gonna be able to? I don't know. How do you think about this when it comes to the bond vigilantes? There's not too much supply, is what we're hearing, or what you're saying is there's not too much supply of treasuries coming onto the market. We know the short-term treasuries, they're pumping out a little more of those. That's what the reverse repo is eating up. But 30 years seems to be breaking out more than like the 3 month and the 2 year. Yeah, it is. The long term rates are going up. So they're just shorting the long end because they know nobody's there to eat them up, right? They're eating the
Yep.
short term. So they're shorting these guys. This is a trade. You got the dollar now pressing. Damn, the dollar's breaking out of that range. That's not great. But again, it's not like a really risk off move. It's like, why are people in the dollar also? Well, risk free interest, right? You're getting
Yep.
yield on the dollar too. So it's
Yeah.
sort of a trade here, especially with oil. Is there really a lot of demand going into the fourth quarter? Everybody knows there's not a whole lot of global demand for oil. China's still struggling. I mean, Evergrande and Country Gardens, whoever, defaulting even more. They're going to struggle a little more. They're going to inject liquidity. That doesn't go into oil. That goes into capital markets first. So where does this end, Josh? Where do you see this bond vigilante slow down at?
Something I learned a long time ago, and it's kind of my mantra, is you don't bet against the Fed. Period. End of story. So if you want to short the bonds and the Fed's not wants you to capitulate, you're going to capitulate eventually.
Right. They can orc. I mean, they could probably. I
They
mean, I
have way
wouldn't
too
even.
many tools in their belt to manipulate the markets to what they want it to do.
I wouldn't even doubt if they are literally like in talks with the next breakdown. Oh, because KRE, yeah, we haven't looked at that today. Always keep in mind that KRE is rolling over. Those are the regional banks. I wouldn't even doubt if they're in talks with whoever's going to collapse and say, oh, look, we're gonna headline it. You guys collapsed, right?
Yep.
We're gonna headline it,
Here's some
but
liquidity.
here's some liquidity. We're gonna back you up. We just need these guys to cover, to get the treasury market in control here. So that's, I guess, yeah, I guess we agree on that. A lot of people just shout out stuff on social media like, "Oh my God, this is gonna collapse." It's not 2008. The Fed is actually in a lot of control. I think people miss QE is the everything code is what some guys call it. QE is the everything code. Why are PEs so high? I know you're not a stock guy, but PE is what the fundamentalists always use, price to
It's called
earnings.
earning.
Why is it going up so much? That's overvalued. It doesn't matter because
Nope.
the Fed injects more liquidity, makes that earnings go higher, and the
Yep.
price goes up.
Yeah.
Right.
I mean, they're doing quantitative tightening, which is what they have to do as far as what the perception is in the world. But they're doing all this stuff that is still pumping in liquidity, and the moment they pivot, quantitative easing comes right back, and we'll see inflation rise again.
You think so?
Yeah.
Okay. I might actually disagree with you on this one.
Okay.
Um, so I think there's two ways it goes. I think inflation comes back if we get fiscal stimulus checks, which you could be talking about that. But I think if the Fed, the way I've learned about it is when they do QE, when they do start buying back all these treasuries, they're putting more money into the bank's hands, pretty much, lowering rates a little bit, yeah, but not necessarily. The banks have to lend. Basically, the crux is the banks have to lend the money out in order for it to become inflationary. But because people's credit sucks so bad, I think if it is inflationary, it's asset inflation. It's certain things that inflate a little bit, but like widespread, I wouldn't think it pushes CPI or core up. I think it would make asset prices go higher, just because all that liquidity really goes to the banks. I mean, correct me if I'm wrong. The banks decide, okay, where are we going to inject this extra capital, and usually it's asset prices for them to go higher. And then when it
Yeah.
comes,
But
go
if
ahead.
the Fed's giving the quantitative easing, most banks are going to start to loosen their credit standards. So as quantitative tightening has happened, we've had credit tightening to almost a halt, right? But as they start to increase the easing and they're giving out some more liquidity, you'll see credit standards start to loosen. You'll see more lending. You'll see that pressure.
Okay, so you're saying either way they're gonna. So I guess it just comes down to what is the magnitude of the easing for
Yeah.
those credit standards? What is the magnitude? If they want to make money, they're gonna lend, right? Because there's more
Yep.
liquidity either way. And so yeah, maybe so. Here's the other thing: if productivity picks up because of it, which who knows, if it does, I would say it's a net nothing.
Yeah.
But if you do get the White House coming out and saying, all right, we're
Stimulus
gonna give
checks.
$500, that's
Yep.
inflationary because it's just
Yeah.
straight. There's no productivity with that. It's just pure,
Well, government spending has
pure
been the
spending,
root of most of this. If you
right?
look at the money, follow the money, and you will see that the stimulus has been a big cause for a lot of the inflationary pressure that we've seen and a lot of the issues we've seen with decreasing savings rates, credit card debt. Basically, what we saw was a hyperinflated market for a short amount of time with all that stimulus, and now we're coming back to reality.
Right. Who do you think is worse for inflation? Do you think it's fiscal or monetary?
Fiscal.
Okay, I'd agree with that. Most people, they bang on the central bank like they're printing money, but I mean the concept of it, they just hear printing money, but it's really like, hey, if you're not producing something, and I also say this, okay, you want to not print money, you want us to go back to not to high rates and no printing. Okay, welcome to the third world. Like you're gonna lose your mortgage, you're gonna lose your auto loans. There will be no loans, there will be no liquidity. We're going to a third world country, right? That's the alternative. So they kind of have to keep the kicking it down the road. It comes down to who's in the White House. How it just happened to be the last president. We had a pretty good economy. Our inflation was pretty much in control. We had a lot of productivity going on, right? And then all of a
Yep.
sudden, you have the certain people come in, make decisions that are not really business. They're not good for business. And then I'm not saying that caused inflation because there was printing. I always tell my mom, hey, there was printing going on too,
Yep.
back then. The difference was there was that extra check. Remember that extra check? I was even like, damn, another check? I was like, I think we're
I,
good now.
I never got one, and so I'm thankful for it because I
Yeah.
was just that was insane.
Yeah, that was insane. So you got another check and blah 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 whatever. Can you Doifer, can you review the tweets on Oh, you were paying attention to that. Yeah. Yeah, we'll take a look at that. Um, so basically, I was looking at some tweets yesterday from I guess Max Anderson. What they were showing, I think this is what you're talking about, right, Doifer? Let me open this up a little bit. There we go. One Duration, U.S. Treasury net issuance over the past months, bills 1.1 trillion, notes 0.2, bond 20 duration 0.1, 0.9 trillion of the one bills were funded by withdrawals from the RRP, roughly 80% issuance. There's a lot of people who are going back and forth saying a bunch of stuff, but basically they're just showing that most of the Fed liquidity from the RRP is going into the short-term
Yep.
bills. So there's no pressure, there's no buying or relief for long-term rates, which is why they're surging. Right now, nobody's buying that.
Yep.
Um, Let me see. Do you have any thoughts on that?
Yeah, I mean, that's just the nature of this type of cycle. You're going to see people pull away from the long term and focus on the shorter term rates just because they don't have to stay long in something when they know there's something's about to break. They're going short term cash, preparing for something. And that's, again, following the money. When you see money going into long term, you know that they are confident that inflation's under check, the economy is going to be doing well, somewhat. But when you see them go short term, they're unsure. So there's a lot of uncertainty in the market, I think.
Okay. Yeah, that makes sense. That's pretty clear right there. What do you think about this? Max Anderson was saying if the federal government keeps spending at the current rate, the RP will be empty by June, July 2024. I guess quick jump for me. I'm like, oh, that makes sense. Well, that's kind of the scary part. Once they run
Yeah.
out, what happens? Is there really no recession coming yet until this RP is empty? Does it happen simultaneously? Do you think the recession will get pushed down the road until RP is gone?
It makes a little sense. I mean, if you want to follow the data and you want to think about it in the respects of the money supply, it it makes a little bit of sense.
Yeah, that's what I'm thinking. What about the consumer now? Let's
Ah,
let's kick it over to the consumer.
yep.
What is the real shape of the consumer right now? Because let me see, what is the story? The story is, the narrative is, in on one camp, consumers are fine. Consumers can keep spending. The baby boomers generation, they're retiring. They have enough cash on the side. They own, the most money by far. It's like 30 trillion. I'd have to go look at it. And, they're spending on services. So the economy will be fine. The consumer's good. And then on the other hand, student loan repayment, higher debt, more debt to pay on their interest payments. You see the mortgage market, blah, blah, blah. Consumer retailers are signaling, hey, we're slowing down here. Walmart, whoever it is. Where do you think the consumer, and we're going to get that report here on Friday. Where do you think the the consumer savings also, I'll jump into that. Where do you think the consumer's at, Josh?
It's a tale of two generations. Not necessarily, but somewhat, right? You have the boomers and then everybody underneath them. And I think what you're seeing is the boomer is keeping the economy moving because of all their assets and what they've done. But they're also of the generation whose parents lived through the Depression. So eventually, if they haven't already, they are going to adjust their spending because they do not want to run out of money. And I know this because I have two boomer parents, and both of them are retired. And conversations with them are very succinct when it comes to the economy. I did not project to have to spend this much money in retirement. I have to adjust my spending if I'm planning on not running out of money before I die. So I think up until now, boomers have been able to spend and be okay. But I think they're smart enough, they've been around the block enough that they're noticing what's happening to their retirement savings and their savings. And you're going to see an adjustment in that spending. So the boomers will not push this economy forward through something. And we already know what's going on with our generation and the generations younger than us. It's impossible, right? We can't make enough money to pay for our groceries, our car loans, our student loans, our bills. I mean, hell, most of our energy bills are starting to go up. In case most people haven't realized, the energy bills are going up double, triple. In California, they're going to start implementing energy bills based on your income in California. So I think those of us in the working class and those of us that are working right now are struggling. Boomers have been okay, but they're starting to struggle. And they have been what's been pushing us through this. And I don't think that continues.
So we should be seeing the ISM services. Well, we should be seeing services slow down then, if that aligns. And I think that's been the case here. And you're right. Like, demographically, boomers or people who are in retirement, they're not stupid. They're gonna die. So they're not gonna. That'd be like the
They had
worst
financial
suffering.
literacy,
Yeah,
most
they
of
have
them.
it.
And
So
like
they're
I
not
said,
gonna.
most of them have parents that lived through the Great Depression.
Right.
And if you knew anybody who lived through the Great Depression and you were close to them, you knew like they had canned goods stacked up in their garage because they were always preparing for another crash. So they understood, fiscal responsibility, and they taught their kids that. Now, don't get me wrong. You talk to some of the younger generations, especially me. Did the boomers teach us those? No, most of them kind of lived the good life. They've done well. They didn't teach us as much financial literacy as their parents taught them, or at least their fiscal responsibility. So they understand it. We are struggling with it. The newer generations are, but the boomers understand it, and they're going to adjust their spending.
Yeah, that makes that does add up. So maybe they slow down here with the rates going up. They're probably going to slow down on their services. And I'm thinking too, after the seasonal effects, right? November, after they help their grandkids, they love
Yep.
their grandkids, like January
Christmas.
going, yeah, after Christmas, it's like boom, you're going to see probably a collapse in that service spending in goods, whatever. And then already the younger crowd, the younger generations, they're not spending. And I always think, what about these YouTuber guys? What about these YouTubers? Have you ever sold a house to anybody or a mortgage that they're a YouTuber?
No.
No, or they do.
Right. Yeah, no, I get you. They're an influencer. They're earning
Mhm.
their money off the views that they get on social media. I've actually never worked with somebody that's done that. I've heard stories through other individuals about helping YouTubers, um, and typically they have large amounts of cash, and they're not necessarily financing a big portion of it,
Mhm.
but I think I was just looking at one the other day. The guy who does the videos on budgets, right? He
Mhm.
goes over budgets with the people that he's helping on his videos on YouTube. He's a YouTuber, and he's always critiquing people on their spending habits, what they're spending, and he's hilarious. Well, he got flipped on the other side of the mic with another influencer, and he called him out. He's like, "You just bought a house, a $900,000 house. You have an $800,000 mortgage. Did that make sense? Is that a good financial responsibility?" And he's like, "Yeah, it was impulsive." So again, financial literacy, do as I say, not as I do. Even he was willing to jump into the frenzy and buy a house that may not have been the best financial decision for him because he's relying solely on his YouTube income.
Okay, that makes sense. So ultimately, the wisdom of the crowd is not there. It is not there. And we will come to a slowing, which again, I think it brings us back to watch out for the White House because I think we're gonna get more stimulus at some point if things get too rash, and then you also have you have the policies, the Inflation Reduction Act, the CHIPS Act. You have that coming on play too. Now, my theory is once those come into play, or as they come into play, because they're kind of like little drains, little injections, right? I think it keeps things kind of cool. Maybe you disagree with me. It keeps things kind of cool to the upside. I'm always an optimist, just because you do lose jobs, you lose spending. I think it gets volatile, but then here's more jobs. Like I'm in Phoenix, and I know California is expensive. Phoenix is kind of expensive, but dude, the amount of apartments being built is insane.
Yep,
Uh,
50-year
Scottsdale,
highs.
you said what?
50-year highs
50-year
on
highs. Yeah, 50-year highs.
apartment multifamily construction
Multifamily construction, and that converts into a lot of
housing.
these side gig jobs, right?
Yep.
And then also you have the manufacturing, the onshoring, the semiconductor onshoring over here. They're building the TSM plant. So I'm thinking, okay, there's more jobs. Now that's not everybody, but
No.
it's not like a big, crazy drop. Now that's here in Phoenix. So I'm sure other places, Mississippi, it's like, whew, I don't know what's happening in Mississippi, those lower end places. So maybe there is like this displacement happening around the U.S. Like there's a big rolling recession here, but not so much on this side, right? But ultimately, it's going to come down to how the Fed navigates these waters. So, and then somebody asked earlier, what do you think the Fed's going to do in the next meeting? What are your have you thought about this,
Oh, they're
Josh?
gonna hike.
You think they're going to hike? Okay.
Yeah,
Damn. Okay. I'm going to take the other side. I'm going to say they pause. I'm going to say they pause here.
they're doing at least one more, like he said, and I bet you they hike.
Okay.
And I think it's because of what we see in the inflationary numbers, and I don't think unemployment's going to tick up. I think the numbers are going to look really good for the economy, and they're going to be like, you know what, we just need to do this now, and then we can watch and see what it does.
Okay. Dang. That's if they're going to hike the market, it makes sense why the market is pricing that in. It has been pricing in. The other negative
Yep.
too, I know I haven't done stocks for you stock guys, is some of these earnings are getting revised down a little bit. They just got
Oh
revised up
yeah.
like 2 weeks ago. They got revised up. Now they're getting revised down. So I'm like, uh-oh. Okay, so they're getting revised down. That's going to cause some turmoil. Right now we got SPY, we got S&P at that 431 level. It didn't bounce as hard as I thought it would. I think we're going to bounce, but the question is on that next move after the bounce, can it get back above a level, right? 444 was that big level. I don't know if it gets there. We'll see if it rolls over again. While you have upward earnings revisions for the Magnificent Seven, Apple, Amazon, Google, Facebook, Tesla, all these guys are getting upward revisions a little bit, and then other sectors are really down, especially KRE. So it's weird. It's weird. It's weird looking. It's a weird looking market here. The home builders were exploding for a while. The home builder and now they're rolling over. So those
Yep.
30-year rates are up. So it just sounds like from your perspective, they're gonna make sure that they orchestrate something breaking, and you just, I mean, maybe the best thing going forward.
Yeah, I think their goal all along was to not kill the economy, but put enough of a hurt on it that they can really get inflation under control because that's their mandate. And what they've done so far hasn't gotten it where it needs to. And they said they need 2% for like an average, not just one time. So if inflation hits 2%, they're not going to start cutting rates. They're most likely going to hold on to them, keep them up higher, and may let it drop below 2% because they want that average to be around 2%. And then they might consider start cutting rates.
Yeah, and they push those out further. The rate cuts, they push them out further, so they're getting pretty damn hawkish here,
Yep.
and that's bothering a lot of people. I think some people are cheering though for something to break. Like, hey, let's just get this over with. Let's get this pain over with, right? Let's pull off
They're
the
dragging it
band-aid.
out. I
Yeah,
mean, the rest of us are all hurting. $1 trillion in credit card debt. Couple that with 20% interest rates on your credit cards, student loan repayments, consumer confidence and spending is going to take a huge hit. Period. End of story.
yeah, that's true. Okay, well, here you go, Biden. Here's your chance to get reelected, huh? That's going to be the chance here. So these elections will be interesting, going into it. What else do we
Huge
have on
market
the?
movers.
You said what?
They're going to be huge market movers.
Huge, yeah, huge market. It's almost like, I think the theory I've had is the stock market's going to start to actually separate from the real economy, because it's going to look forward to the next stimulus, to the next
Start
cuts,
pricing it in.
start pricing it in, while the real economy is really muddy, really
Yep.
sluggish. Maybe some people are doing good, right? Software engineers, you're probably doing pretty good, but a lot of other places really falling apart there. And personal consumption, like, do you think the Fed is just pretty much focused on, you got headline, you got core, blah, 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 whatever. Personal consumption expenditure doesn't really take into account oil prices. So do you think that the Fed is has any chance of do you think there's any chance that the Fed looks and says, okay, well, PC's coming down, we're not looking at oil, we're not going to hike here? Or are you thinking it doesn't matter, they know what they're going to do, they're just trying to like orchestrate expectations to keep the market from maybe blowing up?
I think you're on point with the second point, right?
Mm-hmm.
They're just trying to orchestrate it. And like we mentioned previously, oil has an impact on the cost of everything. It's a small fraction of it, but it does. But the price for barrel of oil doesn't have a direct impact on the consumer at the same level it does for those investing in it, right?
Right.
So, yeah, barrel may go up to $100 a barrel, oil will. But what impact does that have on the consumer? It's a small fraction of it. So that's kind of why they like the PCE number, because it doesn't push too much emphasis on the cost of oil. So I think it, for them, they're always trying to orchestrate something.
Yeah, no, I agree. It's tough too, because it's like they're trying to get the bond market to stop falling by saying we're gonna, something's gonna break, but at the same time, not really. We don't want the stock market to crash too, so not really. And then still increasing liquidity, still, doing that. So it is kind of a day to day, which is why me as a stock market trader, investor, whatever, I really think the macro, forget fundamentals of your company. I think the macro is the most important thing right now for the market. Maybe across all markets. I haven't really thought about it with housing or real estate, but I think the macro is the most important. And and then fundamentally it's whatever, but if you have a catalyst like AI, how does AI factor into it didn't really move the housing market, did it? The AI
No,
narrative? No, okay, yeah. So that's just stocks, which is why I kind of like stocks, because you get this catalyst, and this doesn't always come, and they can kind of like out move the economy for a while, right? If things don't improve, obviously it's a big deal. So do you see a lot of people think inflation comes down a lot faster because of the year over year, not because of the base effects, but because this growth slowdown comes. Do you think we can hit? I know a lot of guys that are macro guys, they're saying, hey, we get to 2% inflation this year on the, would it be the PC? I think it's headline. They think we get a 2% headline this year. I would want to think about, I would want to hear him talk about oil too, but let's take out oil. I think core is, I don't know if you look at it, core is at 3.7. Do you think we can hit 2% with the consumer slowdown, or it's not going to be soon enough by the end
Not
of this
this year.
Not this year.
We're heading into the fourth quarter. Consumer spending. There's Christmas. Yeah, it may not be a great one. But, I kind of mentioned that on our last conversation, right? You know how good or bad the economy is doing by how early they start putting out Christmas. And there are places already putting out Christmas long before Halloween because they know it's mental. So they are going to try to get in front of as many people as possible to spend through the holiday season to try to keep consumer spending and keep the money flowing. So I don't see inflation dropping to 2% before the end of the year, and it's because of the seasonal impact.
Okay. That makes sense. That does make sense there too. There's so many ideas here. What about what was I going to say? What about where do you see the GDP? Do you see GDP? My bad. GDP going negative again. Do you see GDP going negative again? That's another one.
Yeah. I mean, if consumer spending is hurt as bad as I think it is, and everything indicates it's going to be, a large part of our GDP is consumer spending. But don't get me wrong, our government has done a pretty good job of replacing that with government spending. So go to war, GDP goes up. So I think we should see GDP drop, but doesn't mean something's not going to happen at the macro level that will hold it up.
Okay, UAW strikes. I know we talked about this earlier, but we got this now saved on here. The UAW strikes, right? Inflationary for the supply chain.
Yep.
They are there's a lot of layoffs there too. Maybe it's a net negative. Yep. What do you think about the UAW strikes as far as, is this going to be an inflationary wave for vehicle prices?
I think the auto industry is a dying dinosaur in the way that it's currently structured and run. And you and I talked about it. Tesla and Elon Musk is where I think they have to go. And this could just be the tip of the iceberg for the US auto industry and the complete implosion of it.
Right, because they're already underwater. I mean, it's a tough industry as it is. They're underwater, and they're underwater with EVs, and then you got wage growth. I mean, this might be a recipe for a big correction, which I'm trying to now filter in my head. Okay, maybe we do get a bigger correction if we see a rollover in the stock market. And NASDAQ, whatever, who knows, maybe there's a separation there. But the UAW strikes for sure putting a lot of uncertainty. And that brings us to the next one, right? UAW strikes, maybe it's inflationary, maybe not. Either way, there's going to be some chaos because it has to give either way. Either it is going to be inflationary or there's so much loss of growth, something collapses, who knows? And, something has to filter out, right? What about this government shutdown? Is this, in your view, is this real fear? I think, what is it, this week, by the end of this week, right?
Yeah, it's the end of the month. So the 30th.
Oh, it's the end of the month. Okay.
Honestly, this isn't the first time that we've heard it. First time it's happened, won't be the last. It's just posturing and grandstanding. So unless the small group of Republicans who are pushing for ending the continuing resolution or an omnibus, right? Because in the past, every single time they've done this, an omnibus or a continuing resolution has been passed and they've just kicked the can down the road. The reason we're going into the government shutdown isn't because they don't have an omnibus or isn't because they don't have a continuing resolution. It's because there's a small group of people who don't want to kick the can down anymore. They want to change how it's done. So they're pushing for real budgetary fixes for this economy, for the spending, and they're not going to agree to an omnibus, or they're not going to agree to a continuing resolution, which is, if they can stay strong and they can actually do this and force this, there could be a major impact. Before, it was just grandstanding and posturing. Here's a continuing resolution. Here's an omnibus. If those small group of Republicans decide to stand strong and will not agree to an omnibus or a continuing resolution, this shutdown does hurt us.
Okay. Do you think it pushes? Do you think it affects rates higher with the with these traders, or do you think it doesn't matter? Do you think it pushes rates up a little bit? Because I'm thinking too, it'd be another excuse to, okay, look at more issuance. They're raising the debt ceiling again. I don't know if it does anything, but I'm thinking the bond market might continue to have some issues there. I don't know if you've thought about that yet.
Yeah, I mean, honestly, the market's probably already priced in us doing a continuing resolution or an omnibus bill spending, because that's just par for the course. I think if they're able to prevent an omnibus or a continuing resolution, you may see a rally in the bond market, just because they're changing the narrative as far as government spending, and they're not just kicking the can down the road. So, I mean, there's a lot of uncertainty, but I have a feeling that the continued government spending and gluttony already being priced into the market.
Okay. Yeah, I'm saying, what are we gonna get next here, man? What are we gonna get next here? I guess what I have to do for people looking at economic activity is the rollover, right? The rollover in services, the rollover in manufacturing. Manufacturing has been picking back up. It's still in contraction, but it possibly does maybe stage sideways in that contraction area. But I think that fiscal stimulus will pick it up a little bit versus the service activity. That's where, if this thing breaks lower, uh, that's going to be the bad part for the market. Because I know a lot of JP Morgan investment bankers, or market makers, as you like to say, they say, hey, look at new orders for services. That's, if I had to look at one macroeconomic data for the stock market, it'd be new orders, right? Looking into the future. So if those orders start to decline, then we could have definitely some kind of issue here. Maybe it gets kicked down the road. I think we've covered everything. Oh, shoot. There we go. I don't know what that was. I think we covered everything. Josh, you have a wealth of knowledge. I appreciate the meetup, the cooperation here. I think we need to keep this going.
Sounds fun, man. I love it.
All right, guys. I'll have all Josh's information in the show notes, and you guys stay blessed. We'll catch you again for another Macro Monday. Stay blessed, guys.
Thanks, Jeremy.
Thank you, Josh. Thank you.